I'm a certified mortgage advisor, and I want to show you one example of what that means. I've had two examples recently of clients that are putting between 10 and 20% down on a mortgage. These people also have great credit scores, and these people are being offered FHA loans, and I suspect it's because of the interest rate on the FHA versus conventional. Now, you can totally pick whichever mortgage you want to go with, but in this instance, nobody had run the numbers to show these clients which option would be the best for them both in the short term and the long term. This is a mortgage coach presentation, and I do one of these for almost all of my clients. So let's look at the difference between an FHA and conventional at 10% down. The interest rate difference is a 6.25 or a 7.125 based on today's rate. And the monthly payments with taxes and insurance, you can see here. The difference is about $67 a month towards the FHA side. You'll notice cash to close is also cheaper for FHA because of the daily interest. An important thing to note is on FHA with 10% down, you still have a set mortgage insurance premium, and on conventional, you actually shop it the same way you do your interest rate. So in this instance, we actually have a better mortgage insurance rate on conventional with a 10% down. That's most likely because they have really great credit. Now let's look at the 20% down options. We have a 6.25 and a 7.125 rate as well. The monthly payment difference is still about $60, and the cash to close difference is actually a little bit less with the conventional option. You can see that the lowest monthly payment is actually the FHA with 20% down option versus conventional, and then the same thing for the FHA at 10% down. But let's take a look at the total cost of the mortgage insurance, interest, and closing costs for each scenario. When we look at that, the FHA with 10% down is actually the most expensive option. Doing conventional with 10% down actually saves you about $35.96. And same thing for the 20% options. It actually saves you a lot more to do conventional 20% down as opposed to FHA. Again, where it gets interesting, if you look at the interest and MI paid over the next 5 years, you actually do pay a little bit less going the FHA 10% versus the conventional, and then FHA 20% versus the conventional 20% down. The last thing that we would want to look at is the loan balance and equity for future refis or selling. In each instance, their equity position is higher and their loan balance is lower for the conventional option versus the FHA. And that has to do with this right here, upfront mortgage insurance premium. This is a policy that you're required to have on FHA, and it's rolled back into the loan amount, making the loan amount higher on FHA versus conventional. I always like to ask a client what's the most important thing for them to consider, and if it's monthly payment, maybe FHA makes sense in this option. If we're looking more at the long-term impact and looking for a future refi, we might consider a conventional option to keep that loan amount lower once you do go refinance. As I always like to say in mortgage, it just depends on your situation. And if you want to run the numbers on what that looks like, let me know. My contact information is next.